Kitco Mining's special coverage of the Bank of Montreal's 32nd Global Metals, Mining and Critical Minerals Conference is brought to you by First Majestic Silver.
Hello, this is Paul Harris for Kitco. We're here at the 32nd BMO Global Metal Mining and Critical Metals Conference in Florida. Today we're talking about uranium, and a great pleasure to be joined by John Ciampaglia, CEO of Sprott Asset Management. Good morning, John.
Good morning.
It's been a while since we last spoken, but I'd really like to get an update on the Sprott Physical Uranium Trust, which is the ETF you run and that you started about, 18 months ago now. In that time, how's the ETF doing? Is it achieving what you set out to achieve?
I think it's fair to say it's exceeded our wildest expectations. We would have never have predicted that there would have been a massive change in sentiment around nuclear energy. Obviously, that was really driven by two factors. One was decarbonization. The U.S. rejoining the Paris Climate Agreement was a huge symbolic step. And then, unfortunately, in the last 12 months, the world has relearned, I'm going to say, an old term, which is energy security. And the energy systems around the world, obviously, in the last 12 months have had a chaotic ride as Russia has disrupted, a number of major energy markets. And uranium has been part of that. Very geopolitically complicated commodity for sure.
I mean, uranium, obviously, and nuclear has been an energy source for many, many decades, and it's been that sort of energy transition source of energy for decades before people even started talking about energy transition. When I started in the space sort of 20 odd years ago, that was, I guess, the moment in time when uranium and nuclear has really started falling out of favor, but it's really coming back at pace with, as you say, security of energy supply and other concerns. So how does that feed into the outlook for the uranium and nuclear space in general, but obviously the Sprott Physical Uranium Trust in particular?
Yeah, well, we originally got interested in the sector because we just saw a fundamental supply-demand imbalance. The industry went through a pretty difficult bear market that lasted from 2011 to the end of 2019. And over that period of time, we basically closed a lot of the best mines in the world because they weren't economic. And we were essentially producing uranium. Many of the companies were producing uranium at a loss. Now, it's hard to fathom that because you have an energy source that produces 20% of electricity in the United States, produces 10% of electricity worldwide. Where I live in Canada, it produces 60% of our energy. So you've got this critical mineral. It produces reliable baseload power, and it's affordable. And it just really dawned on us that how long could the sector go operating with a structural supply deficit? At some point, you're going to run out of secondary supplies. You're going to run down your inventories, and you need to come back to the market and procure. And this is what we've seen starting to really happen in a meaningful way over the last 12 months. Utilities around the world are obviously getting much more support for their operations. Nuclear power plants are getting life extensions because of the energy crisis and decarbonization goals. And utilities are coming back to market and buying ever larger quantities of uranium, and that's had a big impact on the price.
And the news is also full of stories about new nuclear plants around the world being conceived, licensed, and being built. So your ETF, you actually go out and buy the uranium, yeah? So how has your uranium holdings increased over the 18 months that the ETF has been going?
Sure. So when the fund started in July 2021, we acquired through an acquisition about 18 million pounds of U3O8. That's the form of uranium that we hold. That pile of uranium has grown pretty meaningfully. And the reason it's grown is because we've had incredible investor interest around the world in this thematic. It's related to energy transition. It's related to energy security. And as a result, we've raised a little over $2 billion in the trust. And today the holdings are a little over 60 million pounds. So, to put that into context, 60 million pounds, that sounds like a lot of uranium. It's enough uranium to power 20% of the US electricity for a year and a bit. So the US has the largest fleet of nuclear reactors in the world. They require about 50 million pounds of uranium as feedstock per annum. So we could generate quite a bit of electricity with that energy.
Okay, so with that, you've basically had 3 times growth in your uranium holdings over the 18 months. Have you perceived any sort of that's been responsible for any changes in the uranium market. The price has gone up from, let's say, $25 a pound 12 to 18 months ago to around, let's say, $50 a pound now. Is Sprott responsible for that, or are there other factors driving that as well?
Yeah, I mean, I think investors returning to the sector have clearly helped benefit the entire sector in terms of moving the price of uranium, the price of the related equities. But we think, the big market in uranium is the term market. And that's where the utilities, the end users, are really driving most of the demand. So last year, for example, we think utilities purchased about 130 million pounds via long-term contracts. So that market is really the market that sets the price of uranium. Where we buy uranium is in the spot market. It's the smaller of the two. They are linked. They do trade off each other. But the big market is the term market, and that's really what will drive, we believe, the price of uranium long-term as utilities get life extensions, new plants are built, and then, down the road, 5-10 years from now, the next generation of nuclear reactors, small modular reactors, I think have a lot of hope around the world. And we're seeing massive government support in Canada, the United States, and the UK. There's a bit of a race going on right now to develop and commercialize the next generation of reactors, which I think are going to play a much bigger role going forward.
Thank you, John. Now, in regards to the utilities and the term market, the terms are 3 to 5 years? And I understand that one of those, we're approaching one of those moments in times where a lot of utilities will be looking to secure their next term contracts. Is that typically an exciting time for the uranium market?
It is, because I think for a long time, the utilities felt as though there was an oversupply of material, so there was no urgency. There was no urgency to go and procure. The price kind of meandered in the 20s per pound for a very long time. But when the market dynamics started to change and the narrative started to change about nuclear energy and its role in decarbonization, I think everybody started to take note to say, hey, this market has a structural supply deficit. We need to go back to market and procure. So what we've seen from utilities is they're buying larger amounts of uranium and they're buying for a much longer duration. So you mentioned 3 to 5 years. We sometimes see utilities procure uranium for out to 10 years. We recently saw in the last few weeks, the government of Ukraine procured up to 67 million pounds of uranium from Cameco for up to 12 years delivery. So when you're starting to have utilities buy that quantity of material over very long tenures, I think it tells you everything you need to know about what they're thinking about in terms of their business and their operations. Energy markets, have been very robust in the last year, and these utilities are making a lot of money. So it's very easy for them to go and say, look, we're making money again in our operations. Let's ensure we have the fuel for the future.
Thank you, John. Now, I get to speak to a good number of the exploration and development companies in the Athabasca Basin in Saskatchewan in Canada. And one of the things that they sort of say is that the incentive price is still a ways away. $50 per pound is still a ways away from the incentive price to build out new capacity. What do you think the incentive price is, and how does that fit into Sprott's business model? Because presumably at some point in time, there'll be a price at which you'd look to liquidate your uranium holdings and make lots of money for your investors.
Yeah, so it's a really interesting point. I think everybody's very fixated on this because the whole thesis was about seeing an incentive price in the uranium market to do two things. One was get the existing mines that have been on care and maintenance since 2018 back online. And that's obviously started, and it will continue to accelerate. Those mines are coming back online when the price of uranium hit, somewhere between $50 and $60. We still have other mines in the world that still cannot reopen even at $60 a mine. So let's call those kind of the tier 2 assets. So we're waiting for more announcements to get particularly mines in the US restarted. There are mines in Africa and Australia coming. Okay, so first step in the supply response will be get the existing mines on care and maintenance back online. What about greenfield production? The reality is a lot of the greenfield development and exploration during the bear market was basically frozen. So a lot of these projects did not do anything for many, many years. The last 2 years, obviously things have changed. Capital and interest are coming back into the sector, and that's really the lifeblood for the sector. If you can't attract investor capital, the projects of tomorrow won't be built. So we see a lot of encouraging results. We're seeing a lot of juniors finally getting back to helping to progress their projects, move to environmental permitting, which is a key milestone, and then ultimately build their mines so that in 5-6 years from now, we've got more supply that will come and to feed it into the market. In the short term though, it's a very slow supply response that we're seeing.
It sounds almost, and correct me if I'm wrong, it sounds almost like it's perhaps a little bit too early still for the greenfield developers. And in terms of a question, does a greenfield developer of a uranium project face the same kind of lead time as a developer of a copper project or a developer of a gold project?
Yeah, I mean, all of these projects take enormous amounts of time to go through permitting and construction. There's a lot of stakeholders. Uranium is a sensitive material, and so the process tends to be long. The reality is there are a lot of projects that were moved along the development phase and then kind of stopped in the bear market, and those ones have kind of picked up pretty quickly. But in terms of your incentive pricing to get those mines financed and built, it's way higher than $50. And I think that's part of the thesis that many investors I've talked to have relayed back to me, is saying, we're going to have a supply shortage unless we see the price of uranium at $75, $80, $90, or $100 over the coming years. Because if we don't see that kind of a price point, we won't have future supply. And that's the fundamental bet that a lot of investors are making right now in uranium.
So I imagine that's part of your marketing, is that for investors that want exposure to uranium, investing in the junior developers perhaps is still, well, it's not, the risk there is more of a time risk. How long is it going to be? Whereas you can invest now in Sprott and get direct exposure, and exposure from the $50 upwards towards what will be the eventual incentive pricing.
Yeah, I mean, we see all kinds of investors. We see investors that just simply say, I love the fundamentals of this sector. It's essentially recession-proof. We need the material. It's a critical mineral, or the lights go out. And so we'll just play the spot commodity price, and we'll just ride that. Other investors, obviously, are more risk-taking. They're okay with the volatility of some of these smaller cap stocks. And at Sprott, we've got a range of options. We've got a uranium mining ETF. The ticker is URNM. And we recently launched another ETF called the Sprott Junior Uranium Mining ETF. The ticker is URNJ. And if you really want to play the optionality and exploration upside of these smaller cap companies, you can have fun with that ETF as well.
I've always been impressed by the inventiveness of the Sprott organization to produce products for a whole spread across the different markets. Okay, we're at the BMO Metals and Mining event. So what have been the most interesting or surprising things for you that you've picked up or learnt on?
Yeah, this is my second year, and so I'm not a long veteran of this particular conference, but I am blown away by how many people are here this year. I talked to the conference organizer, and I think they said there's 2,000 people here, and it's the all-time record high in terms of attendance. That is a really good sign, because it tells you that interest is coming back in mining. The reality is 2 or 3 years ago, this conference would have been dead. There would have been very little excitement. A lot of the commodity prices were stuck. Governments weren't really, ringing the alarm bell around reshoring critical supply chains and basically building local supply chains for everything, battery metals and whatnot, and other critical minerals. So I think the entire narrative is shifted for the positive around energy transition, in particular, energy security. And most people have no idea how important metals are for that transition. Incredibly important, big elements of raw materials that go into, we think about it in three different steps. Energy generation, what metals and minerals do you need to generate electricity? So that's uranium and things like silver for solar power. Obviously a lot of steel, aluminum for wind and other sources. And then how do you transmit power? Obviously you need transmission lines, cabling, copper, aluminum, all those things. And then finally, the storage of energy, that really comes down to batteries. Nickel, lithium, graphite, what am I missing here? I'm missing an important one. Lithium, nickel, manganese. There's a whole bunch of critical minerals that you need for battery storage. So whether it's increased electrification, whether it's a greater adoption of electric vehicles, all of these things are going to need more lithium, more copper, more uranium, etc. So we're really excited, and I think that's why you see the people coming back. They see the investment opportunities, the capital is starting to come back, and I think the world is completely underexposed and underweight the commodity sector, coming out of essentially a 10-year bear market for many of these different metals and minerals.
Thank you, John. And to sort of wrap up, what are some of the highlights or catalysts we can expect to see out of Sprott and its uranium products this year?
Yeah, so we continue to do what we do, which is market very actively and educate the market. This uranium market is a very nuanced market. It's very technical. It's very opaque. Most of my time I spend just telling investors how it works. How does the fuel cycle work? How is Russia entangled in this whole uranium sector? Helping them understand the different parts of the sector and the drivers. So that's what we focus on. The markets are the markets. Unfortunately, the last kind of 8 to 10 months, I feel as though the dominant factor in almost all the markets in the world has been the Federal Reserve and other central banks tightening interest rates to curtail inflation. That's really been what's impacting a lot of asset values. It's not been the fundamental drivers or the elements of each particular sector. It's really been this macro kind of headwind that many of the just about every asset class has been facing. So I think as we move past this Federal Reserve uncertainty, people will get back to the basics. People will feel like it's okay to start investing money. There's a lot of capital on the sidelines. So we're just going to keep telling our story and educating the market. And we're very bullish on the price of uranium longer term. And it's a very positive story, and the world's kind of waking up to it. So it's a very interesting topic for us.
Well, let's hope investor money comes back into the sector sooner rather than later. John Ciampaglia, President and CEO of Sprott Asset Management, thank you very much for joining us today.
Thank you for having me.
And I, Paul Harris, stay tuned for more from Kitco at BMO.
Kitco Mining's special coverage of the Bank of Montreal's 32nd Global Metals, Mining and Critical Minerals Conference is brought to you by First Majestic Silver.